Good day, everybody. This is Jim Kinney for August the 31st, last day of August 2018. This is the Option Professor weekly update, and it's great to be with you. As always, I do remind people that past performance is not necessarily indicative of future results, and trading short-term or in the option area does involve risk, and it's not right for everybody. So do make sure you talk to your financial professional or your good common sense or anyone else, clearing firms, to see what, if any of these are appropriate for you. Today, I'm strictly talking about my opinions, and it's great to be with you here today. With regards to the markets, they have been rising, and they have been rising on a number of factors that seem to be fairly sticky, which is earnings going up very strongly, the Fed gradually bringing interest rates up, and of course, unemployment remaining very, very low. And ergo, you've got the consumer with money in his pocket, of course, with the tax cuts for corporation. You know what I always tell people with this tax cut, if you lowered the rim from 10 feet down to 6 feet, everyone would be dunking, right? Well, when you give a tax cut of 40% to corporations, obviously their ability to be profitable and do all kinds of things with extra money does go through the roof. And that's why your share buybacks are supposedly about $1 trillion for the year. And that's why you've got a lot of different maneuvers regarding the financial markets. And again, premium PE expansion is very possible when you've got these kind of earnings and revenue increases. So there's, people say it's in a sweet spot, the economy, and I think very much that's the fact right now. With regards to things that could be a derailer in it, of course, this risk with the trade talks being all over the place a little bit, and a lot of the agreements that I hear on the news seem to be not in writing. So I think there could be a lot of volatility to the trade talks, and that's you got China, who might not be exactly on a let's get this thing done quickly time span. And then if you got Mexico making an agreement but nothing in writing, and now you've got Canada being resistant, we seem to be insisting on them doing something with their dairy tariffs, and they're trying to protect some voting up in Quebec that has a lot to do with dairy. So that doesn't seem to be a hurdle that we're going to get over very easily, because Mr. Trudeau would probably rather get reelected than to throw his dairy farmers under the bus. So a lot of things that could be a little bit volatile in the days and months ahead. But clearly, the big stocks in these indexes are continuing to rise. And so I'm going to start out with a couple of stocks that are in the news here. One is Apple. And let's basically take a look at Apple. Now, today, we're going to go over a wide variety of information like we go over every week. So do hang in there with us, because we are going to go over most everything that you're investing into out there. Apple Computer, obviously, has been going very strong. They've got a meeting in September, and they're supposedly going to be unleashing 3 new products. And one of them is supposed to have some type of a larger screen, and the larger screen really is met with a lot of enthusiasm, because last time in 2015, when they went to a larger screen, the revenues to the firm really jumped dramatically. And of course, with this announcement that they're having this meeting next month, and of course this Apple Watch supposed to get an expanded screen possibly as well. The one caveat is there's supposed to be not any tremendous innovations on the phones, just improvements and wider screens and that type of thing. So only time will tell if everyone will jump ship and jump into the new one, but history says that that's not a bad bet. It made an all-time high here today, as you can see on your screen, $228.87. Someone had said that Buffett was saying that there is an undervaluation of the iPhone, in his opinion. So that's quite a bit. That's quite a big endorsement from him. And of course, he's been a big buyer of the stock ever since the 160, 180 range. And of course, since then, it has broken out. Once it got above the 200 level, it was kind of lights out on the upside. Now, there's a gap way down there at 190. Let's look at some of the other technical picture, because, there's always a situation where you have to remain understanding that the markets don't go straight up forever. So let's take a look and see where we are in Apple going into all this news. Because, if I'm talking about the September meeting, everybody knows about it, right? So maybe some of that is already being discounted, and you always have to be worried about that. Right now, the 200-day average is really where it would be a fantastic place to buy the stock, which is the 180 area. So where you at 230 almost minus your 180, let's get an idea of how far we are above the 200-day, and it's 21%. Anything 20, 30, 40, 50% above the 200-day, in my view, is get the yellow warning flag out that the correction may be able to occur. Here, where you've got a solid news situation, it could go a little bit further. But the first week that you see Apple not making a new high might be a little bit of the week to start doing some hedging. What does hedging mean? And again, this is my opinion, but a covered call writing where you sell an out of the money call on the stock, bring in cash flow, and also bring in a little bit of downside protection. That would be something to consider. And then a collar strategy, where the stock's at 227, you sell a call with a strike price above 227, and then take that premium and buy a put under 227. And now they call that a collar, where you've collared the stock. What does that mean? You've got an upside potential that has a limit, and you've got a downside risk that has a limit. So that means your equity or your value has parameters on it. Whereas if there's nothing on the stock, it can go as high as it wants and as low as it wants without any parameters. Here, where you put a collar on, this is where you're going to try to bracket or put a parameter on your equity, so you know where you're at. You know exactly how much you can make on the maximum side, and then on the downside, you know exactly where your risk is maximum as well. Some people find that comforting. I happen to be one of them, especially if you have a large position or you have a large gain. And so those are a couple of different things to consider when you start seeing it stop making new highs. And of course, today's not that day because we just made the new high today. Again, great company. I mean, you just walk around, every single person in the world to be holding a handheld device. The kids are doing it, so that means the next generation's in on it. And it just is a phenomenon over the last 20 years that has just gripped the entire planet. You always wonder if competition will come in from Samsung or some other outfit, and that's always some type of a risk that could throw water on the parade. But there's a style statement with the iPhone apparently, and people do like to have that name brand a lot of times. But that's the story on Apple right now. Very strong, all-time high today, but again, a little bit extended from its 200-day moving average. So you got to be a little careful when it gets into that kind of relationship, in my opinion. Hey, the other one's Amazon, and Amazon is just that's perfect name for this company, Amazon, right? It's just an animal. It's big, huge, incredible, and so basically we're making all-time highs on that. Oh no, we're just a little bit shy. All-time high is 2025, and it's currently 2016. Was as high as 2022. The story on this company is that they have tremendous, and that's the only word to use on it. Actually, it's one of the few times you hear that word, it might make sense, right? Earnings growth, ridiculously fast. And also, here's the big key, their gross margins are accelerating. Who doesn't want a business? The earnings are growing rapidly, and their gross margins are accelerating. Fantastic business. And supposedly, it's accelerating to a tune of like $20 billion a year that they need to spend, and they can't even spend the money as fast as it's coming in. So most of it's coming in their fulfillment business and other online businesses, 30 to 40% growth rates. That's fantastic. And here's the key that this one guy was saying, and I can't verify everything that I hear or read, but his opinion was that they have about 1.5% of the world's retail business, and he thinks it can go to 5% of the global retail business fairly easily, and 10% in our lifetime. So those are staggering numbers, and that is certainly the momentum that they've created here. So again, it might sound far-fetched to some, and it might sound pretty much kind of like 10 years ago if you said the Apple phone will be as prevalent, or 20 years ago the Apple phones will be as prevalent as they are. Some people might have said you're all doped up, and then other people would have said, hey, that's the momentum, I'm going to ride the wave. Well, the wave on Amazon has been up, and what these people are saying basically is that there's great reasons behind it, and it could have a lot more to go. A couple of the fangers seem to be hitting a snag here. So all fangs are not as sharp as they used to be. And let's look at Facebook. A lot of people still swear by Facebook, but they do have some issues here they're trying to overcome. As you can see, after it got that bad news and went from 220 all the way down, it's had a difficult time getting back above that low point of 190. So, there's a huge gap gap, obviously, between 220 and 190 that it could fill. And so if it got above 190, that'd be very constructive for this stock, in my opinion. But right now, if it breaks under 170, then again, the gap between 160 and 170 could get filled as well. So again, Facebook does have some other firms, other companies they own are popular. So that's something to consider. And let's see what the moving averages look like. But a lot of people still swear by this. Don't forget this ETF buying that people do constantly to put money in the market. It forces these people who are managing the ETF to buy more of the leading stocks. And Apple and Google and Amazon are very big stocks in ETFs. So that puts a little bit of forced buying in there as well, as these ETFs get more and more money as people keep chasing the highs on the market. Again, you can't go to the backyard picnic and keep hearing how much money people are making in stocks before you say, forget it, just get me in. And when people get in, they tend to buy ETFs a lot. And then, of course, that forces the people to buy the Amazons and the Apples and stuff like that. Let's take a look on where you are on the Facebook here. Spending a little time on FANGs because tech has been and continues to be viewed as a very positive sector. Okay. So where you are on the FANGs here? I mean, on the Facebook moving averages. Yeah, 180 is and 185. So they're still inverted to the upside despite the big pullback. That's not a negative. That's actually pretty good. The key is getting back above 180 and 185 so these averages don't turn down. That would not be good technically. So let's just see where we're trading. We're at 175. We're underneath both of these averages. So I gave you two pretty good lines in the sand to keep an eye on, 180 and 185. Get above that, then above 190 that I showed you, then I might get back onto the party train of Facebook. But until then, caution may be the better part of valor. Let's look at Netflix. Okay, Netflix. Another part of the FANG that was going fantastic, and it had a little timeout. And let's see what it's into now. Let's see. Yeah. So anyway, another one that had a gap. You see the gap's right around 390. See, it's just trying to get into that gap there. If it can get above that gap, then it would be a lot more helpful. But right now, it's having a difficult time doing that. And as you can see, it's up today at 374, but it's well off the 423 high that it made earlier in the year. And again, they didn't have quite as many subscribers, I don't believe. And I think that was viewed as a negative, or at least a sobering situation. But that was probably very overbought as well. Let's take a look at the moving averages. Like I've told you, when they get way away from the moving averages, I become very cautious that a lot of the good news has been in there, and hedging or going to the sideline or taking some chips off the table, whatever analogy you want to use, is appropriate possibly. All right, let's take a look at moving average. Yeah, 300. You're at 300 on the 200-day. So, just give you an idea why I get concerned here. When we hit 423 earlier in the year, that 200-day might have been something like 280. 423 minus 280, okay, would have put you 33% above the 200-day average. So, no matter how great a company looks, would it be Boeing, whether it be this company or anything else, when you get that far away from the moving averages, something generally happens to make the thing come back and smell the coffee. So again, keeping an eye on the long-term averages basis the price, I find to be a very effective way to stay out of the hot water and get too carried away when things get very low or very high. Macy's was another one that went way down and everyone abandoned ship. And then, of course, that was the best time to buy underneath $20 a share because it's obviously zoomed back up again. Same thing with Kroger Foods when Walmart, Amazon was supposed to take away all their business. So, be a little bit careful to get too negative or too positive when these things get far away from their averages. Right now, like we say, it's still $75 away from its average. Certainly not as overbought as it was. That's why it looks somewhat more interesting down here on the correction. But we'll have to see what goes on there. Okay, and Google. That'll hit all the FANGs for today. Yeah, if I was to give my opinion, the three horses that seem to still be running fast are Amazon, Apple, and Google, with Google being the lesser of the two. Three, I'm sorry. Having some trouble at 1250. went up there a couple of times. You can see that if it breaks under 1200, then it might go back into the soup. And of course, let's see where this is basis the 200-day average. Again, you got the president talking about he doesn't like when you Google his name, he doesn't like the reports that come out on him. Of course, the antidote to that is stop doing things that make people write bad things about you. But also, he believes the antidote might be talking about antitrust and breaking them up and kind of crazy talk like that. 1103. 1172, those are where the averages are. The only negative also here would be the volumes drying up a little bit. 1.3 million shares on a 50-day basis, 200-day basis, 1.6. So, you're drying up on volume. That's not the greatest news in the world. 1200, very big area. And right now, when it would hit its all-time high at 1273, which was recent, minus the 200-day average, let's call it 1100. Where were you as far as overbought? You're only 13.5%. Now that's not, nothing. That's not nothing, but it's not extremely overbought. So again, if it can hold the 1200 area ballpark, give or take $20, that's a positive sign for Google. And of course, it's a fantastic company. It's got revenue. It's got everything going. And whenever you're looking up anything, you hit the Google button. Totally killed the yellow pages for you older people out there. Again, those are the FANG stocks as we speak. Now, I'm going to go into a couple of other things here. One is going to be right now a couple of sectors that seem to be out of favor, but people are a little bit constructive on. And let me just get something here for us real quick. Energy sector. A lot of people are talking about the energy sector. Let's take a look at that and see what's going on. Here's the story behind that. The story is that the price of oil is probably going to stay above 60 or 65. Okay, and maybe go higher, but 60 or 65 seems to be an area that it will not break under. That's what the thesis is. That's what the idea is. At that level, companies can either be profitable or not profitable. And you've got MLPs, which are master limited partnerships that are heavily into energy. And then you've got stocks. And let's take a look at the index, which is XLE. If we're going to be stable, 60, 65 or better, you want to see if these companies can remain positive. Now, the XLE to me here does not look that exciting. But again, these people are saying there's value here so that if you look 6 or 12 months down the road, rather than seeing 70, 68 or 66, you could see 78, 80 or higher. That's basically what they're saying. Let's see if the moving averages bear that out. Talk is cheap, right? The moving averages don't lie. People lie, right? Moving averages based on time and price. So those are very factual things, right? And they give you an idea of what has happened as far as the flow of traffic. Doesn't tell you what's going to happen, but it can sometimes indicate probabilities. And, nothing's definite. So that's all you're really trying to do when you invest is try to work with some probabilities. All right, there they are. They're inverted, right? They're 73 and 72 ballpark, right? And so where are we trading? We're at 72, 73 area on the 50 and the 200 day, and we're at 74. So where's that right now is a good thing. Now, it looks to me like 70, the recent low area, is certainly an area where you don't want it to get taken out. So you got a pretty good line in the sand between 70 and 72. That's your 200-day average. So you're not that far from it. From that standpoint, that's not a bad thing either. Let's look at some individual companies and see if there's anything we can see there. Hold on one second here. Let me just put up something quickly. Right. Okay. Let's take a look at Exxon. Exxon's paying 4% dividend. It looks just the Excel. You can get this thing back above 82 and get going. Might be something to consider. It looks like it might be trying to form a head and shoulders bottom down here. And we need to get above 82 to get that thing going on the upside. So keep an eye on the Exxon. And if you like to get paid 4% while you watch the movie, that's what the dividend is currently. And when I say that, what I mean is when you buy a stock, you're watching a movie. Is the movie going to be good or it's going to be not good? Does it mean it's going to go up in the future and it's going to be a great movie, or it's going to go down and you're going to lose money? It's going to be a bad movie. But if a company's paying you 4% yield, you're getting paid 4% per annum if they keep paying the dividend, while you're holding on to something. And over time, that can add up, and that's not a terrible thing to get a dividend if the stock's going to be stable to higher. That just adds more fuel to the fire. Let's take a look at Schlumberger, which is another company that people look to in this sector. And we see Schlumberger is again a little bit on the defensive, but if we could get above 65, there could be some value there. Just filled the gap. Used to be 75 and 80. So obviously it's on the defensive, and that's why I guess people are saying is if there's value there, then it could be something that could be very positive. Okay. All right. And another one is Anadarko that people keep an eye on. And let me just get the symbol there, APC. And there you go, $64. And again, looks very much like all of them. They had a rally, they came down, they're stalled out. If we can get strength in the next weeks ahead, again, take a look at some of these. There could be interest here. The other sector that people thought were out of favor is the banks and the financials. So let's take a look at the banking ETF, XLF, and see if there's anything going on there. And the P ratios on these banks are very, very low, and that's why people are saying there's something to keep an eye on here. XLF. Hang on. Okay, there you go. Again, having trouble. He needs to get above that 29 area to really get going. So the banks and the financials, according to some people, are value plays down here because as you look forward, if the economy is going to keep growing, they're going to need more demand on the loans, and they're going to need more buying and selling of companies. And a couple of the ones that I keep an eye on that you got the main banks, J.P. Morgan, Bank of America, Citigroup, and people always say the Citigroup has a very good valuation. But there's two that I keep an eye on because they are still battling out of some news that were not that great. One is Wells Fargo, which is obviously a huge bank and a big holding of Mr. Buffett, and it's trading at 58, paying almost 3% dividend. I see that as a bad thing. And you can see a big gap there between 64 and 62 area, which it may be going up to fill over time. I believe the moving averages on the stock are not bad. 14 PEs, nothing terrible. Almost 3% you get paid while you watch it. And I think everyone's pretty much familiar with Wells Fargo. Not exactly a mom and pop outfit. And there's your moving averages, all at 56. So where's your lines in the sand? You certainly don't want it under 56. And 50 is your ultimate line in the sand. So basically 50 is an area you can see there on the left there. You don't want it under there. And it could pull back a little bit maybe towards the 56 area. And that might give you a chance to get in there. Above 60, that would be very positive, I think. So there's one right there that I've been looking at. And then you've got a situation there on Goldman Sachs. Goldman Sachs has got a new president. They're supposed to be trying to do all kinds of new things. And they are known to be pretty big in the trading environments. And they're having a heck of a time getting above 245. So that would be my line in the sand on the upside. I'd like to see them get above 245. And then, of course, on the downside, they've created a low at 220, and they created a low around 228. So there's your lines in the sand, 220, 228, and then if you want to go with momentum, you want it to break above 245. Those are three things going on there. They don't pay much of a dividend, but if leverage lending and mergers and acquisition picks up and commodities ever make a turn, that could be something there. Okay, real quick, I'm going to go over a couple of other sectors real quick here. I gave you a few to look at. Now I'm going to look at another one here. What if something gets done with China? What might happen to some of these markets? Well, I'll give you one that might have seen a tradable bottom. Maybe, because again, when you've got trade going on badly here, I'm going to give you a few things that I think if things in China over the next 6 months where these things could turn. One is the price of gold. Can you see GLD has been going down, 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 and you see it hit a low there of about let's call it 110 area. Round number 110. I think on the future it's about 1150 or so on the spot price, something like that. It could be a tradable low. So far, it has been a tradable low. And if things improve with China, then of course we could get a bit of a rally in that market. So your line in the sand is the recent lows, which is there it is right there, 111. Right. And then it's at 113, 114. Now, right now, it's maybe setting up on a 1-2-3 formation. The one move was to 115, the pullback right now. So if we take out 115, that would give me much more confident to maybe initiate a position and then basically use this 113 area as a get out point. So basically see if we can take out the 115 area, and then the momentum may have been more pronounced turning up. But an interesting thing there if we do get a turn. Also, if you're in the metals, look at the discount on platinum to the price of gold. There could be a spread opportunity there by buying platinum and selling gold because it's trading over $400 discount to the price of gold. And that'll be interesting to see if that can last, because that seems to me to be a high discount. Okay, the next thing that could occur if the Chinese situation were to get resolved is the dollar may drop. Let's look at the dollar index. It already has started to drop, so maybe that's telling us something. Can you see it went to 97 there on the U.S. dollar? And what a big rally it had. Well, look at the world. The stock markets around the world are getting either hit or going nowhere because of the trade talks. They get resolved, obviously that would be helpful. And with the midterms and Trump really wanting to look like he solved every problem in the world, it wouldn't surprise me if he takes some kind of a deal from these guys just to run around on TV saying he has a deal, even if nothing's in writing. A lot of his deals seem to be not in writing. Not to be political, I'm not on one side or the other, but the North Korea thing's not in writing, and that seems to be going a little bit weird. And the Mexico thing's not in writing, so I hope he has a very strong handshake, because that's the agreement, seem to be handshakes. At this point, the dollar, big rally, 89 all the way up to 97. That's all. Trade talk, strong dollar, people plowing into the dollar. Now it's down around 94, 93. So let's see what it looks like on the moving averages. But the dollar could drop if there's resolution in China. And the moving averages on it, let's take a look. The moving average at 91. So, we get to 97, you're almost 10% above the 200-day average. That's, again, too far away from the 200-day average, and the market's pulling back accordingly. Still a bull market on it, though. 95, 91 are the two averages. They're inverted to the upside. But, of course, news changing like a deal with China could take the technicals and throw them out the window. All right, let's take a look here. So we got the dollar could possibly drop. The gold could possibly go up if there's a deal with China. Now, how about emerging markets? Shouldn't they do better if the dollar does better? So EEM is something to look at as well. And as you can see, just like the oil and everything else, you had a run up a little bit, and then you've had a pullback. Hold on here. Let me cue up the screen properly so you can see it. You had a pullback off 44. So if we can close above 44, that'd be very constructive for EEM, and that would make it much more interesting. And then, of course, if you got to deal with China, that could really make it go if the dollar started dropping as well. How about Europe? The DAX is going nowhere. I keep watching it every day. 12,000 and a little bit of change. 12,000 a little bit of change. And of course, China will do probably picking up as well if you get a deal with them. But here's your European thing. Again, same story. Run up, pull back. Now you want to get above that tip there. You want to get above 39.40. And if you can get above 39.40, then the future on this might change dramatically. So keep an eye on Europe. Keep an eye on emerging markets. Keep an eye on the dollar, and keep an eye on the Europe and gold. And then see if, in fact, you get a turn, if, in fact, that happens. One other thing I wanted to go over is the interest rate picture. Let's look at the 10-year note. Look at it every week. Try to keep an eye on it. Inflation's nowhere to be found. It came out this week. It's lousy. And so these interest rates are having a hard time going up, because although the Fed's hiking, inflation, they can't get that thing going. In fact, maybe they got the tariffs going to cause inflation. Anyway, if the yields start dropping under 280, going down to 260 pretty fast could very well happen. If this stock market rolls over and has some kind of correction in September, I would imagine you'll break 280 and maybe go down. Get above 3%, then these guys who are talking 3.5%, 4%, 5%, like Jamie Dimon was saying over time, 5% 10-year note, that would make sense if we start breaking above 3, a lot more than it makes sense right now. As you can see, this thing is having a hard time holding on for dear life at 280. That's the yield on the 10-year note. Looks like we're going to get close to inverting, and inverting has been negative for the forecasting of stocks, so keep an eye on that. But right now, that's what's going on in the 10-year note. And the last thing is soybeans. You know, there could be something big going on in soybeans if we got a deal with China, because that is a big buyer, and these other people are just not big buyers. Um, there you go. Really got a big tank job here, and he did come out with a support package, a bailout deal, but for only people that are making under 125 grand. Those are the ones who are getting the lion's share of that bailout. So remember that. Is it a double bottom down here at 825? I'm sure the longs are hoping that, but right now it's still very much on the defensive. If we get a deal with China, going back towards that resistance at 10 is not off the question as far as I'm concerned. All right, I'm going to wrap up now. We did cover a lot this week. We cover a lot every week, and I invite you to give me an email if you have any questions or you want to talk about any of your positions or things that you'd like some illumination on from my end. I'm Jim Kinney, and you can reach me at optionprofessor@gmail.com. So I'm inviting you to do that. OptionProfessor@gmail.com. Until next week, I wish you all the best luck in trading. And friends, it's good to have you with us, and be with you next week for the weekly update for the Option Professor. Good day, everybody.